The data doesn't lie. And right now, it's screaming the same pattern it screamed in 1929, the same pattern it screamed in 2000, the same pattern it screamed in 2008. A 150-year-old chart, created by a pig farmer with zero financial training, has predicted every major market crash with eerie accuracy. The 1929 collapse, the dot-com bubble, the 2008 financial crisis, even the COVID crash of 2020. And now, that same chart is pointing to 2026 as the final year of good times before a 7-year economic nightmare begins. But here's where it gets darker. On the exact month this chart predicted a market peak, Donald Trump just nominated Kevin Warsh, a man Wall Street calls the inflation hawk, to take control of the Federal Reserve. Your mortgage rate, your crypto portfolio, your retirement savings, everything is about to change. The algorithm has already run. The pattern is complete, and whether you profit or perish in the coming months depends on what you do in the next 10 minutes. By the end of this video, you'll know exactly which signals to watch, signals that have predicted every major crash for 150 years. But first, you need to understand what's happening right now behind closed doors at the Federal Reserve. January 30th, 2026. Trump makes it official. Kevin Warsh, former Fed governor, Wall Street insider, inflation hawk, will replace Jerome Powell as chairman of the Federal Reserve. Markets immediately react. Gold crashes 8% in a single day, its biggest drop in decades. Silver plunges 25%. Bitcoin, which had been riding high, begins its descent towards $77,000. Why? Because the algorithm knows what's coming. Kevin Warsh isn't like other Fed chairs. During the 2008 financial crisis, while banks were collapsing and unemployment was spiking, Warsh was warning about inflation that never materialized. He wanted to keep interest rates high even as the economy fell apart. History proved him wrong. Inflation stayed low for years, but Warsh never forgot. He spent 15 years crafting his comeback. And now, he has the ultimate power. Trump wants lower interest rates. He's been screaming for rate cuts, 1%, 2%. Whatever it takes to juice the economy and drop mortgage rates before the 2026 midterms. But here's the tension nobody's talking about. Warsh is simultaneously pushing two contradictory policies: rate cuts to appease Trump and aggressive balance sheet reduction, draining trillions of dollars from the financial system. It's like trying to accelerate and brake at the same time. Wall Street analysts are confused. JP Morgan says no more rate cuts this year. Goldman Sachs sees a 25% recession probability. Bloomberg's survey shows economists split down the middle, but one group isn't confused. The old money, the institutions, the people who read patterns, not headlines. They're looking at something else entirely, something that's been hiding in plain sight for 150 years. And that brings us back to the chart, the Benner cycle. 1873, Samuel Benner, a pig farmer in Ohio, loses everything in a financial panic. His farm is wiped out, his livestock dead from disease. He's broke, desperate, and angry. But instead of giving up, Benner does something unusual. He starts tracking patterns, crop prices, market cycles, solar activity. For years, he obsessively charts every boom and bust going back to 1780. And then he sees it, the pattern. Markets don't move randomly, they follow a rhythm. An 18 to 20 year cycle of panic, boom, and collapse. Like clockwork, Benner creates a chart. 3 rows, panic years, when markets crash. Good times, when prices peak and smart money sells. Hard times, when everything bottoms and fortunes are made by those who buy. The chart predicts the future all the way to 2059. Here's what makes it terrifying. The chart has been right, eerily, impossibly right. It called the 1929 crash the worst in American history. It flagged 1999 as a peak year, right before the dot-com bubble burst. It marked 2007 as a sell signal, months before the 2008 financial crisis destroyed trillions in wealth. It even showed late 2019 as a warning, just before COVID sent markets into freefall in 2020. Now, look at 2026. According to the Benner cycle, we're in the final year of good times. The market should peak late this year or early 2027. After that, a transition into hard times lasting until 2032. 7 years of pain. But here's where it gets interesting. Modern researchers discovered something Benner couldn't have known. His cycle aligns almost perfectly with solar cycles, the 11-year pattern of the sun's magnetic activity. NASA data confirms it. Solar maximum is expected in 2025 to 2026, just like the cycle predicted. And there's more. The cycle also correlates with Bitcoin halvings. The 4-year event where Bitcoin supply gets cut in half. The 2024 halving happened. History says Bitcoin peaks 12 to 18 months after a halving. That timeline, it points to late 2026. The Benner cycle, solar cycles, Bitcoin halvings, 3 completely independent patterns, all converging on the same moment, right now. Some call it pseudoscience, coincidence. Pattern seeking gone wrong, but institutions aren't laughing. 79% of institutional investors surveyed by Natixis expect a market correction in 2026. 49% see a 10 to 20% decline. 20% expect something worse. JP Morgan puts recession odds at 35%. The New York Fed's model shows a 20% probability. Prediction markets on Polymarket show a 36% chance of recession by year's end. The data doesn't lie. And right now, it's all pointing to the same conclusion. So, what does Kevin Warsh do with all this? That's a $60 trillion question. Because Warsh is a paradox. He's historically been an inflation hawk, someone who prioritizes fighting inflation over protecting jobs. But now, he's advocating for rate cuts while Trump breathes down his neck, demanding cheaper money. Here's his play. Warsh argues that AI-driven productivity gains mean the economy can grow faster without triggering inflation. Therefore, rates can come down. It's a seductive theory, and it might even be correct in normal times. But these aren't normal times. Inflation is still sitting at 2.8%, above the Fed's 2% target. Unemployment is at 4.4% and rising. Layoffs are accelerating. Amazon, 14,000 workers. UPS, 48,000. Intel, 25,000. Microsoft, 15,000. Meanwhile, the Buffett indicator, Warren Buffett's favorite market valuation metric, is at an all-time high, over 230%. Historically, anything above 200% signals extreme overvaluation. The S&P 500 just had 3 straight years of double-digit gains. That almost never happens without a correction. And here's the kicker. Warsh wants to shrink the Fed's balance sheet aggressively. That means draining trillions of dollars from the financial system. When you reduce liquidity while markets are overvalued, you create a powder keg. One spark, a geopolitical crisis, a debt default, a bank failure, and everything ignites. History shows us what happens next. In the 1970s, Nixon pressured Fed Chair Arthur Burns to keep rates low before the 1972 election. Burns complied. Inflation exploded. It took a decade and a brutal recession to fix it. Warsh knows this history. He wrote about it. The question is, will he repeat it? Wall Street is betting no. They think Warsh will cut rates this year, maybe 2 quarter-point cuts to appease Trump. But then, in 2027, after the midterms, his hawkish instincts will return. That's when the pain starts. Because if Warsh pivots to fighting inflation while the economy is weakening, we get the worst of both worlds. Stagflation, high prices, low growth, rising unemployment. The Benner cycle calls this hard times, and it predicts it lasts until 2032. So, what do you do? First, understand this. The market doesn't care about your feelings. It doesn't care about fairness. It only cares about data. And the data is clear. 2026 is not the year to chase FOMO. It's not the year to leverage up on meme stocks or high-risk crypto plays. Benner's chart says it plainly. This is the time to sell, to take profits, to play defense. History backs this up. During good time in the Benner cycle, annual returns average 16.6%. During hard times, 7.2%. You make your money in the bull run, you protect it in the bear market. Real estate, mortgage rates haven't dropped despite Fed cuts. Long-term rates are driven by inflation expectations and treasury yields, not the Fed's short-term rate. If Warsh shrinks the balance sheet, long-term rates could spike higher. Housing could get more expensive, not less. Crypto, Bitcoin is volatile. Predictions range from 75,000 to 250,000 by year end. Institutional money is flowing in through ETFs. But if a recession hits and liquidity dries up, Bitcoin historically crashes 40 to 60% from peak. Stocks? The S&P 500 is expensive. If earnings growth slows and Warsh turns hawkish, we could see a 20 to 30% correction. That wipes out trillions in retirement accounts. The smart money isn't panicking, but they're not complacent either. They're hedging, building cash positions, rotating into defensive sectors, healthcare, utilities, consumer staples, because they know something most people don't. Markets are cyclical. They always have been. They always will be. The Benner cycle isn't magic, but it's a reminder, a framework, a way to think beyond the noise. And right now, the cycle is saying the same thing it's been saying for 150 years. Winter is coming. The algorithm has run. The data doesn't lie. Kevin Warsh's nomination wasn't random. The Benner cycle's warning isn't coincidence. The convergence of solar cycles, Bitcoin halvings, institutional fear, it's all pointing to the same moment. 2026 isn't just another year, it's the inflection point, the peak before the fall. You can't control what the Fed does. You can't control market cycles, but you can control how you respond. The next 12 months will define the next decade of your financial life. Will you be the one who saw it coming, or the one left wondering what happened? Data does not lie. Want to know the exact signals and indicators to predict market crashes that have been proven through many financial crises? Then subscribe to my channel and see you in the next video.